Binary decisions introduce stress. They're what we call all or nothing thinking. And the problem with binary decisions is that it can put people in a state where they feel like they're damned if they do and they're damned if they don't. We're on a huge run right now in stocks. You might have positions that are working really well, but you also in your mind know that the market might be getting overbought. You get into this situation where you're like, should I hold it knowing it's overbought, or should I sell it and miss out on potentially a great trade? If I sell it and it goes higher, that was a mistake. Or if I don't sell it and it goes lower, well, that was a mistake. And so we start to create stress around binary decisions. Dilemma versus choice. Now we're really talking about trading in the matrix. When I named my company the Trading Matrix, there are a number of reasons why I did this. But the big one actually revolved around making trading decisions and seeing trading possibilities. I find that most people, when they trade, actually trade from a very limiting frame. There's very few options for how they can choose what to trade and how they actually trade. And this is important because the less options we have to choose from, the more stress there'll be around our decisions, and the worse our performance will be. A dilemma is a circumstance in which a choice must be made between two alternatives that seem equally undesirable. Choice is an option. What do I talk about all the time? Options. Choice is an option, a decision, an opportunity to choose or select something. Now, today I'm going to introduce an incredibly powerful concept, a concept that if you embrace this, it could completely change your trading and it could bring down the stress you have around your trading in a massive way. And that is the concept of psychological smoothing. So what is psychological smoothing? It's converting any decision into a framework where the decision is executed over a series of steps instead of just one. In the process, it lessens the impact of any one decision. So let's talk about this for a minute. So we talked about a dilemma. Well, a dilemma is really a binary decision. And binary decisions introduce stress. They're what we call all or nothing thinking. And the problem with binary decisions is that it can put people in a state where they feel like they're damned if they do and they're damned if they don't. So I'll give you an example. Let's just say that, look at the recent market behavior. We're on a huge run right now in stocks. And so in the last week, you might have positions that are working really well, but you also in your mind know that the market might be getting overbought. So in your framework, you're getting into this area. You know, you've heard from me the idea that we need to have big winning trades. But at the same time, you know that your position might be overbought and you're concerned that you're going to give all your profits back. You get into this situation where you're like, well, I don't want to sell it because what if it keeps going up? And I'll miss out. If I don't sell it, well, the market may sell off because I know it's overbought and I may give a whole bunch of my profits back. I may even go to a loss. So should I hold it knowing it's overbought, or should I sell it and miss out on potentially a great trade? Miss out potentially on a big R trade. So we start getting in this mode, geez, if I sell it and it goes higher, that was a mistake. Or if I don't sell it and it goes lower, well, that was a mistake. And so we start to create stress around binary decisions. Another important aspect is the average person holds about 7 bits of information in their conscious mind. If they're really in flow, they might hold 11, 13, but on average, it's about 7. As we introduce stress, the amount of information our conscious mind can hold starts to decrease. And when we're under really high stress, we can only think about one thing. The question I often get, I got this a lot right before the election is, well, I've got a bunch of stocks that have been going up a lot this year, and I know the election could create some volatility, may have the market sell off. So what should I do? Should I just get out of my stocks or should I hold them? And the first thing I say to them is, you're asking the wrong question. You shouldn't be asking the question of should I hold them or get out. That's never, ever the question you should ask. Instead, we should be aware of psychological smoothing. In psychological smoothing, we move away from one decision point to several decision points. And what this does is this reduces the stress around any single decision. So for example, if I'm long one contract, then my every decision I make is to stay in or get out. And because there's only one contract and I've created this dilemma, there's actually a lot of stress around selling one contract, even if the money's small, because we want to win. We want to feel like we optimize the situation. So there's a lot of stress around having one contract on. But if you had 100 contracts on and I asked you about selling one contract, you'd be like, oh, that's no big deal. I'll sell one. Like no stress at all. And why is there no stress? Because you have 99 left. One has virtually no impact on the decision to you. So it's easy for you to make. So this is what professional traders do. There's several reasons for this, but one of them is the psychological side. So if I'm a big trader and I want to put on a big position, I'm not going to put it on in one shot. I'm going to put it on in units. I'm going to buy some. I'm going to buy some more. I'm going to buy some more, and I'm going to work into my position. I might do it in 2 units. I might do it in 3 units. I might do it in 4 or 5 units, but I'm going to work my way in. Then when I come out, I'm going to scale out. I'm going to sell 20%. I'm going to sell another 20%. I'm going to sell another 20%. And then ironically, what that does is that actually sets up the professional trader to be able to scalp or trade around the position. Because if I've built my way into long 100% and then I sell 20% out, and now the market comes back in, well, I can just buy it back and put the whole position on. Goes back up, I sell another 20%, I sell another 20%, comes back in, I buy 20% back. Smoothing your decisions is actually a great way to put you in flow state. It's a great way to put you in a rhythm with the market. And I always believe that we trade best when we're in a rhythm with the market. One of the reasons that I love options is they take psychological smoothing to a whole nother level. Just an example we had that if I'm long one contract and that introduces all kinds of stress, well, if I'm aware of options, I can smooth one contract. If I'm long one contract of E-mini futures, I could sell a 30 delta call against my position as a hedge. It's equivalent of selling 30% of my position. This still allows me to manage the 70% that remains. Another thing is we use multiple time frames. Multiple time frames give us a lot of different choices for how we can manage a position. And then finally, going back to options again, we introduce this concept of metamorphosis. Metamorphosis is one of the most powerful concepts in trading. Because what metamorphosis does is it shows us how to take any given position and to be able to metamorphosize it into any one of many different positions. So just in this case, it shows how when you're in a position, you literally have like limitless, almost infinite possibilities of how you could trade against it or how you could express it. So this, for example, is a graph of just being long underlying, long stock. So I'm long stock. Well, there's all kinds of things that I could do. I could turn my long stock into a long synthetic straddle in which I make money regardless of where the market goes. I could take my long stock and turn it into a short put in which I'd collect money if I sit here. I'd make money if we rally. I could take my long stock and turn it into a short straddle where I make money if we sit and lose money if we move. Or I could take my long stock and turn it into a long call where I have unlimited profit potential, limited downside. And so each of these moves are an adjustment to an initial position. So my initial position is I buy stock. Okay, great. The stock starts to rally. What could I do? I could buy a put against my stock, and this puts me into a synthetic long call. Now I'm long potentially at a credit. Like I'm long with a locked in profit. I still have unlimited profit potential, but if the market rolls over, I don't have to do anything. I could just exercise my put and be out. And this does things like be able to remove stops. So I don't need to stop anymore. And then I can be patient in reading the market. When we understand metamorphosis, we're never boxed in. And now we never boxed in, we have the ability to execute at a much higher level because we have the ability to execute and hedge our positions, smooth our positions in places that have liquidity, places that have tight bid-ask spreads. And this could massively transform your trading. This is why I call it the trading matrix, because in any given point, any trade that you're in is surrounded by a matrix of possibilities of how to manage it. You are never, ever put in a place where you have to make where you are in a dilemma. You never, ever, ever have to be put in a place where you're in a dilemma. You always have choices, and the choices are almost literally infinite. So what's great about this is it not only improves the quality of your trading, it reduces the stress. And that alone can be invaluable. It makes trading more joyful. It makes trading more interesting. It makes trading relaxing. It allows you to expand your brain and truly trade as an intellectual exercise, not just an exercise in emotional control. This is another example. This is in a class that we're teaching right now on vertical spreads. People look at a vertical spread and say, well, I buy a call spread. What's the big deal? But they don't realize that there's actually a matrix of possibilities of how you express a bull spread. And each of them has different characteristics, even though it's the same spread. Some of them can have small gains that are highly reliable, high probability, but potentially big losses. Some of them have low reliability, low probability, but have potential for big gains. Some of them do really well when volatility is high. Some of them do really well when volatility is low. Same spread, the same concept. So when we understand this, we can express things in an optimal way. I'm so big on this concept of the trading matrix. First and foremost, to expand our mind, to realize that we're never a victim, that we're always in a place of empowerment, that there's so many different ways to get what we want. So we never have to be boxed in by people's opinions or the opinion of the system. That you can move around and operate in any environment from a place of joy, a place of gratitude, a place of service, a place of stimulation. Then we move it into trading. And in trading, we see a world that is literally infinite with possibilities. Ways to go get exactly what we want in any given moment. Not just buy something and hope it goes up and then sell it, hoping it doesn't continue to go up. This is powerful, powerful stuff. So I invite you to continue on this journey with me in which I show you so many different ways to improve the quality of your life and to improve the quality of trading. Because remember, I'm Chuck Whitman and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the largest proprietary trading firms and hedge funds in the United States. And what day is it? Yeah, it's Tuesday. But it's not any Tuesday. It's Trader Tip Tuesday. And Trader Tip Tuesday, I come to you with tips like today of dilemma versus choice that help you take your performance to an elite level. I'll see you next Tuesday.